Hello, folks. My name is Brett Pattison. I am a partner and portfolio manager here at IGGA Global Advisors. And I am really excited to talk to you for a few minutes about what we call our alpha approach. And it's an approach that we have here at IGGA Global to using options. Now, we use options for a variety of ways, which we'll discuss here in a minute. And we'll talk about really mainly one of those ways today. And that is this. This is what we'll hit on for a few minutes. We'll hit on and define what is alpha. It's a common term that's used in the world of investing. Some of you may have heard of it. Some of you may have not heard about it, but we'll define it nonetheless, and you will have an understanding as we leave. We will also talk about the role of options in a portfolio. Why would we use options, right? What's their role? It's kind of and perceived to be a complex product in the world of investing, and we'll shine light that it isn't so complex today. And then also we'll talk about the alpha option strategy and discuss the basics of what that means and why we utilize it. And so a couple things that you need to know up front as well, and that is if you have an understanding about options, most of this, if not all of this, will make sense. If you've never learned about an option in your life, this is going to be a lot of new material. Don't worry, you will still understand the why behind adding alpha, we'll call it. You'll understand the benefits even if you don't understand the complexities for it. So don't go anywhere. Both groups don't go anywhere. I'm sure there's going to be a lot for you all to learn. So let's start out by defining and looking at what we call a model portfolio. And when I bring this up, a model portfolio is just how an allocation, a portfolio would be allocated, right? And this is just illustrative purposes. It's an example, but you've got U.S. stocks is 35% of a portfolio. You've got all international stocks as well. So you have equities that make up a large portion of your portfolio. Then you got bonds, and we'll call it income-producing products. May not be totally bonds. You might have something else in there. But then you've got this green sliver that we call alternative investments, and that's where your options would be. But you've got to understand that the portfolio as a whole is what we're looking at. And so the strategies that we talk about today are not just alternative investing, but we're looking at the portfolio as a whole. And to understand why we're looking at a portfolio as a whole, we need to bring up portfolio volatility. Here's a simple chart of the S&P 500, which is the U.S. market. We'll call it the U.S. stock market. Okay, from 2006 to 2014, into the first week of 2015, actually. But you can see there that there are a lot of ups and downs. All right, I'm going to highlight a few. There's one right there in 2008, which a lot of us experienced. There's a couple more as we go along. Volatility in a portfolio is the amount that it, percentage-wise or dollar-wise, however you want to look at it, goes up and down. In 2008, tremendous amount of volatility. The market was sliced in half. Most portfolios, as a result, also lost, maybe a half, maybe a little less, maybe even a little bit more. That's portfolio volatility. Anytime the market goes up and down, as we're seeing in that picture, that's portfolio volatility. Well, some people can stomach volatility, and some people can't. In fact, we have this saying on our website, and I really like it. It says this: if you are in or on the cusp of retirement, the last thing you can't have is a major hit to your portfolio like we saw in 2008. So if you are in or on the cusp of retirement and you're counting on that portfolio to help you through retirement, portfolio volatility, especially downward volatility, you can't have it hit you as maybe you have been able to in the past, right? And so very important that you understand volatility, because that's one of the goals of the strategy that we will be talking about. And in fact, speaking of goals, there's two goals of most investors. Not all investors, but most investors.
And that is, when I talk to them, they're looking to enhance returns. Everybody wants to make money, right? They want enhanced returns, but at the same time, they don't want a whole lot of portfolio volatility that we just looked at. So if there's a way that we can, we don't want to go up and down as much as the market, but we still want to make money because we still need to grow it, because we retire at 60, in our 60s, but we live till we're in our 80s, and so we need to continue to grow that money. Well, that's the definition, my friends, of alpha. That first thing, enhanced returns. That second thing, lower portfolio volatility. That is alpha. And ultimately, the goal of alpha, I drew on a little chart here. That's that red line, and I drew this in, and this is purely hypothetical, right? But the ultimate goal of any alpha strategy, and ours included, would be to lose less when the market goes down, right? And eventually make more when the market goes up. Now, that's not always going to happen. In fact, it's impossible that it happens all the time. You can see when the market is very bullish that gray is above the red. And that's okay, because certainly you're still making money, but the portfolio volatility, you can see down there in 2008, where we had this big drawdown, you're not losing as much. And that's the ultimate goal of the alpha strategy, is to smooth out your portfolio volatility, your portfolio returns, your portfolio dollar amount up and down. It's to smooth that out so you can maybe sleep a little bit better at night, right? That's the ultimate goal of the alpha strategy and what we apply to individuals' portfolios. So we've got a lot of tools at our disposal to use, right, to smooth out and to decrease that portfolio volatility. There's allocation. Certainly you can allocate, and have non-correlated asset classes within your portfolio, and that's great. That can do it. That maybe not get you the returns you want, but that can certainly decrease portfolio volatility. You can use technical analysis, which is great, which we do. You can use any other type of analysis that's out there, right? The main tool that we'll be talking about today is options, right? That's the primary tool we'll talk about. And there are many tools out there, by the way, but let's talk about options. There's three primary reasons why options are used. The first one that I'll bring up is protection. We use options as protection, and there's many strategies that we can use to help protect, a portfolio or a concentrated stock position. There's many strategies we can use. The second thing is also income. Income is the component that helps you enhance returns. So when I say enhance returns, in large part what I'm meaning is income, right? There's strategies that produce income, and then there's pure speculation. And I don't really like pure speculation. In fact, as a firm, we don't speculate on stock prices, right? Or using options. I guess everybody's a speculator once it comes down to it, but we're not going to buy options betting on the direction of a stock in the short term. That's just not what we do. That's not a high probability strategy. So what we'll do, and what we do is focus on protection and income, right? And so let's bring up a very basic strategy, which is covered calls. Now, if you're familiar with options, you know what a covered call is. If you're not, then you're going to be learning new material, and I'll try to break it down quickly and still make it understandable, right? So you have a covered call, and we're going to start out breaking down covered calls by looking at Amazon.com stock. In this picture on that slide, and I'm going to use my pointer here, you can see that we own 100 shares of stock. The stock at this time frame, and this is just an example, but the stock at this time frame was trading at $261.24. On this particular day, the stock was down $7.61. So it was getting hit, right? In fact, you're losing, if I scroll over here to the right, you're losing $761 that day. right? For long-term stock investors, that's maybe not that big a deal, but certainly nobody likes to lose money. Okay, so insert covered calls. A covered call is an option strategy where an investor writes or sells a call against a long stock or ETF for the purpose of receiving a premium. So let's say this. You own 100 shares of Amazon stock. The stock's going down, but even before that, and you'd have to know before this, you'd have to make the move before the stock was down, but you'd say this. Essentially, what I'm going to do is I'm going to sell a covered call. I'm going to sell a covered call. Now, what that means is if I sell something, it's you enter into a contract and you're saying to the other person on the other side of the contract, look, I'm going to sell you a $280 covered call. In this case, we'll say a June. Ignore all the numbers that you see and focus on this. I'm going to sell you a June 280 covered call. But you know what? I need to be paid for it. And that 280 call, by the way, just so that we're all on the same page, what that means is if Amazon goes above 280 on an expiration date, which I'm not going to get into a great lot of detail, right? But if it goes above 280, then you will be forced and obligated to sell your Amazon stock at $280, right? So that stock you own, that 100 shares, if it goes above 280, you're obligated to give that stock on expiration day. All right? Well, if it stays below 280, then you keep the premium. Let's say you were paid $5 for selling the call. You keep that $5, right? So essentially you're I don't want to say betting, but you sell that covered call anticipating that, okay, if the stock goes above 280, I'm going to give away my stock. I'll still keep the option premium or the $5 that I got. If it stays below 280, great. I keep my stock and I keep the premium, right? And that's the best of both worlds. You can see on this particular day, and here's what I want to highlight in particular. You can see on this particular day, the stock was down $7.61. Well, the option, the 280 option, actually made money. And I'm going to scroll all the way to the right here. You can see on that day, that $280 call that you sold made $183, right? So big deal. Well, here's the big deal. Instead of on a day when Amazon lost you $761, you made $183 on the call, so your net loss on the trade, and I'll highlight that here in a moment, but your net loss on the trade is mitigated. So what does this mean? Well, if the stock goes up slightly, goes sideways or down, you keep the money on the premium. In our example, $5. You keep that. Well, if the stock goes up a lot, you have to give away your stock. So your gains are capped at 280. But on this day, it reduces your loss and over time can increase your returns. And this is what I wanted to highlight. Instead of being down $761, you're only down $578. You're still losing money, just not as much. So see how that works. It reduces your volatility. And if your objective is that Amazon's going to continue to go up over time, then you just added premium to your Amazon position in the way of the covered call, and you still have the prospects that Amazon's going to go up. Right? So it reduces your loss, your portfolio volatility, and can increase your returns over time. Now, I know that's a lot. If you're new to options, that's a lot to take in. So don't worry about understanding it all. I'm going to highlight some of the things that you need to know here in a moment. Okay? Let's look at an equity portfolio. For example, let's say you own all these stocks. You own Apple, Bank of America, you own Berkshire, and this is a small portfolio. You've got some ETFs. You got all sorts of different products in here. And you say to yourself, well, I want to sell covered calls on every one of those. But you know what? I got a day job. That's going to be hard. And that's a lot to manage. And I'm not, in fact, I don't want to sell my my Apple or my Union Pacific. I don't want to sell that. I never want to sell that. All right, so why would I sell a covered call if I don't want to sell a stock? Well, here's another way that you can still take advantage of the covered call. You can still enhance returns. You can still reduce your risk, your portfolio volatility. And it's a strategy that is our core alpha strategy. It's a bear call vertical spread, or otherwise also known as a short call vertical. You can see that bear is friendly. It's a friendly, bearish strategy. And what it incorporates is it's a defined risk trade. It's defined gain, so you can only make so much, just like with the covered call. You can only make whatever the premium is. Well, this as well, right? It's a high probability trade, which our firm completely that's our focus as a firm is on probabilities, the right probabilities. And so what it is you're selling a call, just like we did with the covered call. And remember, when we sold the call, we take on the obligation, right? We're obligated to deliver our stock, our Amazon stock, right? That's what happens when you sell a call. Well, when you buy a call, you have the right to buy the stock, right, from somebody else. So you're taking the other side of the contract. So when you sell a call, you're obligated. When you buy a call, you have the right. You have the right to buy that stock or that index or whatever it may be at a certain price, whatever that price is. Okay? So let's break this down even more, and live examples are best. I'm going to look at the Russell 2000. The Russell 2000 small cap index. This index is down on this particular day 16.5 points or 1.6%. So it's enough. It's a day that would get your attention. Certainly, if it, and the Russell 2000 is highly correlated to the S&P 500, to the U.S. market as a whole, and so most of the equities in your portfolio this particular day will also be down, right? Down 1.5% ish. Okay, so that's what happened on this particular day. Now you can see that we don't own any Russell 2000. We don't own the index. All right, and that's important to know. We don't own it. In Amazon, we did own it, right? We don't own the Russell 2000. But what I want to do this particular day is I'm going to sell, and actually, it was done prior to this day, but this is the example. We sold 10, you can see quantity 10 of the June 1035 call, right? Well, we learned in the Amazon example that when the market's down, those short calls make money. And that's the case here as well. We made on that short call $1,700. On a day when your portfolio is down, you're making money. Beautiful thing, right? Beautiful thing. The problem with just that is we don't own any stock. We don't own the index. So it's what we call naked. And nobody wants to be naked, right? It gets cold. So it's a naked call position, which we don't want. It wouldn't be if we owned the underlying, which in this case we don't. We don't own this index. It's a cash settled and we don't own it, right? So our risk is substantial. What if the Russell 2000 went up to 1100 and we were short the 1035 calls? Well, we'd be forced, right, to deliver that stock to somebody or that index at 1035. And that would be a great risk to us. So how do we reduce our risk? Well, we reduce our risk by buying a June 1045 call, right? Because that 1045 gives us the right to buy that index at 1045. So we are obligated to deliver it to somebody for 1035. Well, okay, we can turn around and buy it for 1045. So our risk is defined. It's defined to the difference between 1035 and 1045. But we have to pay money for buying this 1045 call. And anytime you buy a call and the market's down, you're going to lose money, or the underlying is down, you're going to lose money. So in this case, you made $1,700, close to $1,800 by selling the call, but you lost $1,100 by buying the call. That's the spread. So net, if you think about it, you're still up. In fact, you're up $650 on the day. So on a day on a day when the market's down 1.5%, you're making $650. So what does that mean? Well, and what just happened? Well, the spread made you money. We know that. So your portfolio, it lost less. If you think about most of the underlyings in your portfolio are losing money, well, we're making money on this spread trade. So we're losing less. What does that mean? It means it reduces your portfolio volatility. That's what that means. All right? And that's one of the alpha goals, right? And over time, because of the nature of the probabilities of the spread, over time, that spread should add to your overall returns of your portfolio. So when we look back at this chart that I drew, that line that I drew, okay, you're going to have moments where, let me grab my mouse here, you're going to have moments, you can see you're underperforming the market. The market's a shaded gray. Your red line is your portfolio. There's going to be moments when you're underperforming the market because you're utilizing this strategy. There will be times where you're losing less than the market, and that's one of the main goals. Reduce portfolio volatility. But at the end of the day, the probabilities of the spread should work out over time. And I'm not talking 6 months, a year, but years, right? Over time, the probabilities work, and you should enhance returns over time. So you're reducing portfolio volatility, you're adding to your returns. That's the ultimate goal of this alpha strategy. So we'll stop there. Here's what we discussed. We defined alpha. What is alpha? We defined it. We looked at the role of options in a portfolio by looking at really two strategies. And we're talking about adding alpha option strategy in particular. Okay? There's other option strategies that we use as a firm. Selling puts straight for income is the goal there. We use collars. If anybody has a concentrated stock position, needs to protect it. Can't sell the stock. You don't want to sell the stock, but you need protection. Collars can do that. We do long puts for protection. We do vertical spreads, which we just reviewed, long and short, right? To reduce portfolio volatility, mainly short. All right, those are other option strategies. So here's what I would say. Hopefully you understood the benefit, right, of options and how we manage portfolios. I would just say relax. You know, we can definitely take it from here if you want these strategies utilized in your portfolio, but you don't want to take the time to do it yourself. That's why we are here. So if you have any questions, comments, you want to learn more about options, whatever it may be, feel free to email me at brett@igga.com. My phone number, or our firm phone number, 888-591-0334. You can see you can connect with me on Twitter, on LinkedIn. Of course, email is probably the best way to get me. Also the phone. But feel free to reach out with any questions. For those of you that are clients and are watching this, really do appreciate, you're the reason why we do this, what we do, and we really are excited about this strategy as we implement it for our clients, including you. For those that are not clients, reach out. You know, we can definitely help. That said, hope everybody has a terrific day. Thanks for listening.
This is a purely public broadcast and is not intended to be personalized financial advice for any individual's specific situation. Each individual's financial situation is unique, and the topics discussed on this broadcast should not be relied upon and or considered as personalized advice. Specific financial securities discussed are not intended to address any listener's particular financial situation and should not be considered recommendations. This is for educational purposes only. For more information, please contact Iron Gate Global Advisors at info@igga.com or by calling 888-591-0334.